So basically now the bank is able to say get the funds for the purpose of that is doing for the business. One important aspect over here is that whatever the loans which bank had given, so it was given for a very long time period. Let us say that it was given for 10 years, 15 years, 20 years. That was the time period for which the loan was given. Now, in comparison to that, so you will be able to get the funds immediately for the purpose of doing further business. That is the reason we understand that so the financial intermediary would be interested in doing this transaction. And along with that, so there are certain other advantages also for the securitization. Let us see question number 1. What is securitization and explain the process of the securitization? Answer of the question. Some companies who are involved in sending money or making credit sales must have huge receivable in their balance sheet. Though they have the huge receivable, but still they may face liquidity crunch to run their business or to expand. One way may be to adopt borrowing route, but this results into the change in the debt equity ratio. Now friends, over here we understand one more important point is that whatever the scale at which the bank has already reached by doing the initial business. Now if at all the bank wants to further expand, then in that case we may think that the bank should raise further, let us say that's finance, maybe direct debt finance, instead of going for this entire procedure. But in that case, what will happen? One important thing is that the banks are required to maintain certain capital structure ratios. So going for more and more debt financing may not be permissible to the bank legally. And at the same time, raising further and further debt financing is going to decrease, we can say that's the borrowing capacity of the bank, because certain capital structure ratios say may change very adversely, and that does not allow the bank to raise a further debt finance. That is what's the reason that we have that going for this process would be better rather than going for the debt financing. One way may be to adopt the borrowing route, but this results into the change in the debt equity ratio of the company, which may not be acceptable to some stakeholders, but also put the companies into the financial risk, which affects the future borrowing by the company. So that is going to affect the future borrowing capacity of the bank. That is, the company over here means bank. To overcome this problem, the term securitization was coined. The definition is like this, if at all you can write in examination, exact definition. Securitization is the process of taking an illiquid asset or group of assets and through financial engineering transforming them into a security. See, the term illiquid asset stands for the loans which have been given to like the clients. Why? Because it is going to be converted into liquid over a very long period of time. That is the reason it is given a name as illiquid. Group of the assets means like the similar kind of loans, so they have been transferred. Through financial engineering means this concept is like some innovative concept. So it is given a name as the financial engineering, transforming them into a security. Means what does it say? It says that ultimately it is converted into security, and you will be able to receive the funds. Not directly, however indirectly. What can be securitization? So which are the assets that can be converted, that is for which the securitization is possible? A few examples are auto loan, student loan, mortgages means house property loan, credit card receivable, lease payments, that is lease rentals which you are going to receive, and accounts receivable, that is the debtors. Originator means in our simple language bank. It is the initiator of the deal who termed as the securitization. It is an entity which sells the assets lying in its books and receivables and receives the funds generated through sale of such assets. The originator transfers both legal as well as the beneficial interest to the special purpose vehicle or special purpose entity. So basically it is a bank who will transfer all these assets say to the special purpose vehicle. Special purpose vehicle or special purpose enterprise created for the purpose of executing the deal. Since the issuer originator transfers all rights and the assets to the special purpose vehicle, it holds legal title of these assets. It is created especially for the purpose of securitization only and normally could be in form of a company, in form of a trust, in form of a society, or in form of a trust. That is what we understand. So visual representation, originator, borrowers and special purpose vehicle. As investors are what we are going to see later on, mutual funds and so on. The main objective of creating special purpose vehicle is to remove the asset from the balance sheet of the originator. Since special purpose vehicle make an upfront payment to the originator, it holds the key position in the overall process of the securitization. Further, it also issues the security and it is given a name as asset-backed security or mortgage-backed security. It will be in form of pay-through certificate of pass-through security to the investors. Investors are the buyers of the securitized paper, which may be an individual and institutional investor such as mutual fund, provident fund, insurance companies, financial institution, etc. Since they acquired the participating in the total pool of the assets or the receivable, they receive their money back in form of interest and principal as per the terms of agreement. So of course they are supposed to get say some additional amount in comparison to the investment that they had made. Concept: the process of the securitization typically involves creation of the pool of the assets from illiquid financial assets. Pool means that the assets generating steady cash flows are pulled and transferred to special purpose vehicle, such as receivable or loans which are marketable. In other words, it is a process of repackaging or rebundling of illiquid assets into marketable securities. So the different loans are bundled, rebundling, and so it is transferred to the special purpose vehicle. This can be, as what we have just seen, automobile loan, credit card receivable, residential mortgages means house property loan, any other form of the future receivable. This is what we understand.